Imagine the ultimate geopolitical nightmare. A tiny 20-mile stretch of water handling a fifth of the world's oil suddenly becomes impassable. In March 2026, this became reality. Missiles and drones launched by the Iran Revolutionary Guard Corps began targeting vessels attempting to navigate the Strait of Hormuz, grinding maritime traffic to an absolute halt. Looking at the sheer volume of energy trapped behind that blockade, the logical expectation is an immediate catastrophic collapse of the global economy. But when the dust settled, global oil production only actually shrunk by about 8%. This diagram highlights a massive mathematical mismatch. While this downward dip shows the relatively small 8% drop in physical supply, the price axis explodes upward with a staggering 60% spike. That extreme gap between a tiny physical shortage and an astronomical price jump proves that human panic, not physical scarcity, dictated the global price of oil. While the world braced for the physical oil flow to stop, the nations producing that oil had quietly spent decades preparing for this exact scenario. Countries like the United Arab Emirates, Iran, and Saudi Arabia had already laid thousands of miles of massive backup pipelines across the desert, explicitly designed to route their exports right past the blockaded strait. Saudi Arabia, for instance, activated a massive contingency plan, a trans-peninsula pipeline capable of diverting up to 5 million barrels of crude a day directly to terminals on the Red Sea. Because of these geographic workarounds, a massive volume of oil continued escaping the Gulf and flowing out into the global market. If the pipelines worked and the oil was still moving, what exactly triggered a 60% explosion in price? Engineering can easily bypass a physical military blockade. It is completely powerless to bypass the psychology of financial panic. To understand our vulnerability here, we have to look at a foundational economic concept called elasticity of demand. This scale illustrates products like cereal. If prices rise, shoppers swap boxes, keeping prices stable. But swap cereal for a barrel of oil, and alternatives vanish. You can't skip commuting, and trucks won't stop. Demand is locked, sending the price rocketing upward. Economists rate oil's short-term elasticity at a negative 0.1. This artificially choked off the short-term supply even further. Then the next domino fell. Global marine insurance companies, spooked by the drone strikes, simultaneously canceled all war risk policies overnight. When those insurers finally returned to the table to offer new coverage, they ruthlessly jacked up their premiums to 10 times the normal pre-war rates. Suddenly, a massive financial burden was added to the physical transport of energy, tacking millions of dollars in artificial costs onto every single tanker leaving the region. Traders and insurers engineered a self-fulfilling prophecy, manufacturing rampant inflation purely out of raw panic. Ultimately, that 60% price spike had almost nothing to do with the world actually running out of oil. For years, markets believed the wealth and development of Gulf nations insulated them from regional conflict. Iran's swift closure of the strait permanently destroyed that assumption. As long as the Strait of Hormuz serves as a critical logistics route, global financial markets will constantly price the terror of another sudden closure into everyday costs. The inflated price at the pump now represents a permanent, inescapable fear tax levied by financial markets against the rest of the world.